All right, so let's run through some examples here of what constitutes a tax and in some cases what doesn't. So payment of a driver's license, is that a tax or not? Well, it's again kind of like the park situation I talked about. You're receiving I guess the privilege of driving plus you're getting a uh, actual license with your payment. So that's not a tax. Uh, Payment by the required by the government to have your house appraised if you're about to sell it. That's not a tax because the payment is for an appraisal. That's a direct benefit as well. Payments for hotel use of 1% of the bill to pay for city projects. So here you've got a payment that's being earmarked for a certain use, and as the book points out, that's a tax because you're not receiving a particular specific benefit from that. Payment for rental car use of 3% of the bill to pay for the roads. Well, again, you're not receiving benefit of uh, using a specific road, I guess you might say. It's just roads overall, so that would be a tax as well. All right, so how do you calculate the tax? Well, you take the tax base and multiply it by the tax rate. The rate is usually, well, it's uh, specified by a percentage of the tax base. And so the tax base usually is expressed in monetary terms, dollars, uh, based upon the amount of income that you receive during a particular period, the tax year. And so you take the tax base, the amount that's taxable to you, and you multiply it by whatever level rate that is specified in the U.S. tax code. And so that would be the amount of tax that you owe. Now, we measure taxes, rates, in three different ways. And some of this can help you to better understand the amount that you're paying, how it relates to your overall income. And so, and for marginal tax rate, it can help you to plan how to structure things. And so the marginal rate is the tax rate that applies to the next additional increment of a taxpayer's income. If you will, it's the tax rate that you would pay on the next dollar or group of dollars. And so for that, if you look on page 5 of chapter 1, you see the formula. It's you have your marginal tax rate is equal to, in your numerator, it's the new total tax minus the old total tax, and then the denominator that you divide that into, the difference between the two, is the new taxable income minus the old taxable income. All right, so that'll give you your marginal tax rate. Now, note that your marginal tax rate only changes when you move from one tax rate to another. So, if I'm in the 25% tax bracket and I receive an additional dollar that doesn't raise me into another tax bracket, the next tax bracket, which would be at this moment 28%, my marginal rate on that extra dollar is still 25%. Now, if I were to receive a promotion that will give me, let's say, $60,000 more dollars, and a portion of that $60,000 will be taxed at that, not at the 25% rate, but at a 28% rate, let's say on the last 30,000 of it, that's where the marginal tax rate will be something between 25 and 28%. Okay, so that's where you have to figure out the new total tax minus the old total tax and divide it into the new taxable income minus the old taxable income. And so there's some examples there in the book. Make sure you look at those. Example 1-4 shows you an example of that. Average tax rate, you simply take the amount of total tax you paid and divide it into the denominator, which is taxable income. Now, you don't know it yet, but not all income that you receive is taxable. You'll find that some taxes are deferred. They're not taxed this year, but they're taxed next year, or I should say some income is not taxed now. It's deferred till a later time. Some income is not taxed because it's permanently excluded. And so we call those exclusions. And so, but here, taxable income is any income that's subject to taxation. Now note, effective tax rate. Here this includes, as your denominator, all income that a taxpayer receives, both taxable and non-taxable. And so here you're taking the amount of income you pay in your numerator and dividing it into all income, both taxable and non-taxable. All right, so we have an example here. Bill and Mercedes have $160,000 of taxable income and additional $10,000 of non-taxable income using the 2016 married filing joint rates. Of course, now we're on 2017, so I'm not sure why they're using 16. But again, this is just to show you how this works. What is their tax due, average tax rate, and effective tax rate? Then they pose an additional question. If they received an additional $80,000 of taxable income, what is their marginal tax rate on this income? All right, so as far as tax due, and again, this is based upon 2016 numbers, so this would change with 2017 numbers. I guess they didn't have them, the authors didn't have the 17 numbers at the time they distributed this PowerPoint. So here, 31,684.50 is the amount of their tax due, and you would simply take that number and divide it into the 160,000 for your average tax rate. That's the amount of taxable income. Now, for the effective tax rate, notice that they've added the additional 10,000 of non-taxable income to the denominator. And so that makes the effective tax rate lower than the average tax rate. Going to the marginal tax rate, notice that they've moved into a higher bracket, and so a portion of that additional $80,000 moves them into a higher bracket, which causes their marginal tax rate to be 28.42, so it's somewhere between 28% tax bracket and the higher tax bracket that they went into because of the additional income. All right, so there are different types of tax rate structures depending on the type of tax you're talking about. There's all different types of taxes that we'll discuss here in a minute. One type of tax rate structure is called a flat tax or proportional tax rate. It imposes a constant rate throughout the tax base. A common example of a proportional tax rate would be sales tax. If you live in a state that has sales tax, it's a flat rate, and everybody pays that rate. Unlike a sales tax, the federal income tax system is a progressive tax rate, and so it imposes a larger marginal tax rate as the tax base increases. And so again, if you look at the example on page example 1-3 on page 6, notice here, and we'll talk more about this in the future, that under married filing jointly as well as surviving spouses, certain amounts of taxes are taxed at different levels. And so if you make between $1 and $18,650, you're taxed at a rate of 10%. If you make more than $18,650 but less than $75,900, well, on the first $18,650 you're still taxed at 10%, right? $1,865, and then anything over $18,650 you're taxed at 15%, and on and on and on. So that's how the progressive tax system works in federal income tax, as well as, far as I know, all states who have a state income tax. A regressive tax rate imposes a decreasing marginal tax rate as the tax base increases. The big example here would be Social Security taxes, and that's a tax on the amount of income you make. It's paid by your employer as well as your you personally, taken out of your personal paycheck. And so again, a good example of that is the Social Security tax. And let's see, I'm trying to find the rate. I think it's $127,000. And so what happens is with Social Security tax, you pay on the 6.2% out of your paycheck, Social Security tax, and your employer has to match that. And if you receive during the year more than $127,000, then at that point your employer stops taking it out of both your paycheck, and they're no longer obligated to pay any more than 127,000 times 6.2%. And so it asks, how would a chart look, which is mapping out the three different tax structures. And so proportional would all be one rate, so it would stay the same on a graph. As far as progressive is concerned, there you have a tax rate on the left side, and then tax base, or your taxable income at the bottom, is going to increase. And there you have the regressive tax decreasing over the tax base. Types of taxes. Well, the one we're studying is federal taxes, so that's the one we're going to concentrate on. And the main one we're going to concentrate on is income taxes, because that's what this course is really all about. But just so you know, there's other types of taxes, like we talked about, employment and unemployment taxes, something called excise taxes, something called transfer taxes. State and local taxes. You have sales and use taxes, property taxes, income taxes, and excise taxes as well. And then something called implicit taxes. Some statistics. Income taxes represent 58% of all tax revenues collected in the United States to fund the federal government. And you can see that a large portion of that comes out of individuals, not corporations. Again, this was the example we talked about, Social Security taxes, under the regressive tax structure. You also have something called the Medicare tax, which is a tax on 2.9% of your income. 1.45 of that comes out of your paycheck, and your employer has to match that as well. Unlike Social Security taxes, which is capped at $127,000 of your income, or each employee's income, there's no limit on the amount you can make that's subject to Medicare tax. Unemployment taxes fund temporary unemployment benefits for individuals terminated from their jobs without cause. So that's another form of tax. And that comes out of the employer's money, not yours. Excise taxes are levied on the quantity of products sold. Not really familiar with it, but apparently it's a pretty large amount. Estate and gift taxes is taxed on essentially the privilege to transfer property to your heirs or beneficiaries. Sales and use taxes, should be pretty familiar with those unless you live in Oregon, which doesn't have a sales tax. Property taxes are a big one. Tax based upon the value of your property. And you can have both real property taxes as well as personal property taxes. It's based upon the appraisal of the value of either the real property or personal property. And again, you can have state income taxes as well, and those vary from state to state. And then you have something called implicit taxes. And so these are indirect taxes that result from a tax advantage the government grants to certain transactions. And so the main example here is non-taxable municipal bonds. If you buy a bond from a state or local government agency, the interest on those bonds are non-taxable. Because they are non-taxable, the government entity knows that they can pay less interest to people who buy their bonds. And so the difference between what the municipal bond would pay in interest versus a corporate bond would pay in interest is going to be different, because municipal bonds are tax preferred because the interest is non-taxable to the recipients, whereas the interest on a corporate bond is taxable. And so, for instance, a municipal bond could sell at, say, 6%, whereas a corporate bond, in order to be competitive with the municipal bond, would have to pay 8 or 9%. And the difference in the two remains in the fact that the corporate bond being subject to tax, the people considering buying the bond want to look at the after-tax benefit to them, not the before-tax benefit. Okay? And so implicit taxes are defined as the reduced before-tax return that a tax-favored asset produces because of its tax advantage status. And so if you look in the book, there should be an example of this. On page 16, example 1-12. Make sure you look at that and understand the difference there between Coca-Cola's bond, which is a corporate bond, thus taxable, and the state of Georgia bond, which is non-taxable, and why a potential investor might prefer one over the other. All right, policy questions. How do you evaluate different tax systems? What makes for a good tax system? Well, the experts, whoever they are, have looked at this and based how to determine or evaluate a different tax system to see if it's working sufficiently or correctly by the following factors, looking at the following factors. Sufficiency involves assessing the aggregate size of the tax revenues that must be generated. And so, will the amount of taxes received be sufficient to fund all the functions of the government is the basic question. Number two, fairness. Is it fair to taxpayers? And fairness is, of course, in the eyes of the beholder. And so you have to look at it different ways. One of the ways is horizontally. So and fairness and equity are the same here. Horizontal equity simply means that two taxpayers in similar situations should pay the same amount of taxes. That doesn't always happen, but for instance, two taxpayers making $30,000 in taxable income should be paying the same amount, right? Well, that's not necessarily true, because what if one owns a home and the other doesn't? The other rents. Well, the one who owns a home would be able to deduct the interest they pay on the mortgage plus property taxes and other stuff. So they're going to pay less in taxes because of those tax benefits, those deductions, than the other person who makes $30,000 who and rents. So that's sometimes hard to attain horizontal equity. As far as vertical equity is concerned, the thought there is one with a greater ability to pay taxes, meaning they make more income, should pay more in taxes at a higher rate. And so I think from that standpoint, some would argue that we do have vertical equity, although some people might say, well, the rich should pay more, because let's face it, 50% of taxpayers don't actually pay any taxes. It's the rich who are paying most of the taxes. Like it or not, that's the truth. What about certainty? Certainty means that taxpayers should be able to determine when to pay the tax, where to pay the tax, and how to determine the tax. Certainly, when to pay the tax is certainty. Where to pay the tax is usually pretty clear. What's not so certain is how to determine the tax, and this is where people gripe about the complexity of the tax system. You have to, if your taxes are fairly complex, you have to hire an expert, tax expert, to help you determine the amount of taxes you owe. Convenience. The tax system should be designed to be collected without undue hardship to the taxpayer. Certainly from that standpoint, because of the pay-as-you-go system, if you're employed, your employer takes it out of your paycheck for the most part. It's fairly convenient. economy should minimize the compliance and administration costs associated with the tax system. Uh, you know, if you're uh, have a fairly simple structure, you make an income, and you don't have a lot of complex situations going on that would cause you hardship in determining your tax uh, amount owed. Certainly, economy is not a big problem for you, but as you start making more money and life gets more complicated, uh, the administration costs go up with the hiring of tax experts. All right, so that's it for chapter 1. Make sure you look at those examples, because those examples really will help solidify your understanding.